Hello and welcome to the webinar. My name is James Hughes, Chief Market Analyst here at SM Invest. Thank you very much for taking your time to join our webinar today. And as you would know, if you've been coming to our webinars or you're part of our community, then we have been doing these completely free of charge webinars every single day over the last couple of weeks. Today is our topic, and we'll go very much similar to what we have done previously. We go for about 20 minutes to half an hour or so, sometimes a little bit more, sometimes a little bit less. But today we'll do our normal way we tend to do with this, and the way we run these is we look at the markets, and we're in such crazy volatile times at the moment within these financial markets that we look at financial markets, we look at what's moving, we look at the big stories and how everything is tying into the overall discussion about markets at the moment. But then we add an educational aspect to it. So we look at various different points where we should be trading, where we think maybe we should look at various different other points. And we try and make our decision one way or the other on how we think markets are going to go. Now we have placed some trades in the past, but we tend to mainly look to analyze these markets and see exactly what the sort of how we can add these educational points that we talk about, how we can add those onto the charts that we're trading. So that's something that we focus on. So let's start by looking at the markets, and there's been two key things today. There's been two key announcements. First of all, let's look at the oil price. Now, oil has been dominating what happens in these markets, and since the coronavirus outbreak has come in, then we have been looking at global oil demand falling very, very, very aggressively. Now, we've been waiting for some kind of announcement or some kind of deal to happen with oil producing nations, maybe OPEC nations, to step in and make sure that the over demand for oil that we're getting at the moment, the lack of demand that we're getting for oil at the moment is somehow altered by the amount of oil which is pumped out the ground. Now, because there's been a big discussion about exactly how far how storage costs have rocketed, because obviously there's a lot of oil out there which isn't being used. You've got airlines grounded. I mean, you just take the airline industry. Some airlines, and you look at the airline industry as a whole, you're talking about almost for the UK around 15 million barrels a day. So 15 million barrels a day is an incredible amount of oil to be focused on. So with that storage cost going up, it's costing these companies millions and millions of dollars to keep the oil in storage areas. So the cheapest way to store oil is to keep it in the ground and don't pump it. So what we've been waiting for is some sort of deal between OPEC or announcement from OPEC, which of course is dominated by Saudi Arabia, the US, who are self-sufficient in their oil, one of the largest oil pumping nations in the world now, probably the number one, and Russia, who really dominate the non-OPEC members. And today we have heard Donald Trump. Well, he has tweeted, and he tweeted saying the market that he has spoken to President Putin, and he has spoken to Saudi Arabia on the phone, and he expects a 10 to 15 million barrel a day cut in output. Now, that is why we're seeing this massive move. That's why we've seen oil jump from where it was trading down at around $23.35 all the way up to those highs. So that's why we've seen that move. So enormous market moves there on the back of those announcements, and it's not a surprise because we have been waiting for something along those lines to come in and give us an idea about where these markets were going to go. The overall, we can see this move was massive, and it was always going to be a massive move. But we're now seeing, which is a key yeah, we always see this sort of movement, don't we? We see a big movement to one side, and then we see a big reaction coming down to the other side. Okay, sorry about that. Just a brief technical issue. So you can see the movement in this market, big movement to the upside, and then a brief fall to the downside. So you can see, but this is likely to continue. Now, whenever we get a big announcement of something, whether it be a non-farm payroll, or which we'll come to in a minute, because our second announcement, our second big thing of the day was around jobs. But what we often see is a big move one way and a big move the other way. Now, it's key. It's really interesting that when we get an announcement like this, people tend to try and buy in and ride the wave of this thing higher. But what's really important to do when we get to market, when we look at financial markets, is to give the market room to breathe. We have to remember that the market is a living, breathing thing. It moves in the same sort of way because it's dominated by traders like us. We go in, we go in. Yes, there's a lot of algorithms in the market as well, but we go in and we place trades one way, we place trades another way. And we're buyers and sellers looking into a market. So there is always a knee-jerk reaction where the algorithms kick in and take the market higher after certain announcements. Big trades, big traders come in and move these markets to the upside. So we see a big move, a big jump up there, and then we see a situation where the market comes off a little bit. And that is the situation where we find ourselves at the moment. Okay. So that's the reason we get one move there, and then we get a secondary move. So we always have to look for the market to calm down, and then we make our decision on what way the market is going to trade, which way we should go, whether we should trade one way, whether we should trade the other way. But then we make our decision on the other side. So our one announcement today, our first announcement, was about whether we get the output cut that we saw. But also today was announced, we saw the weekly jobless numbers. Now, these have been incredibly important for financial markets over the last last couple of weeks, because it gives us a gauge of just how much the overall impact of coronavirus, what that is doing to our financial markets. You know, what that's doing to our overall economy. Now, the big thing when it comes to an economic performance is whether we are looking at jobs, people losing jobs. Unemployment numbers are key for the economy. There's two things you need in a functioning economy, and that's spending and lending, meaning that people need to be spending money and banks need to be lending money. Now, if people don't have jobs, they can't spend money. It is as simple as that. That is where we look, and that is the most common theme whenever it comes to any sort of economics. Now, what we saw today was an announcement, the initial jobless claims out of the US, which is released every single Thursday. And the number is usually, what it shows how many new employment claims there were in the previous week. So how many more Americans are claiming unemployment benefit in the last 7 days. Now, usually, as I say, around 250 to 500,000. That's the level we get. The number last week was 3.2 million. The number this week was 6.6 million. So absolutely enormous numbers. Almost 10 million people in the space of 2 weeks claiming unemployment benefit. So the issue comes in where when that number comes out, we see big movements in markets, and we saw a big sell-off here. However, we have seen this since turned around, and that again is on the back of this oil price announcement. So we had this oil price announcement, and we have seen markets move higher, because you have to remember that big oil prices, oil companies within the Dow Jones, they're moving higher on the back of this. So we've seen the likes of companies in the UK, BP and Shell. They've both traded to the upside aggressively today. We've also seen the likes of ExxonMobil in the US trade massively to the upside on the back of that announcement as well. So it has a wide-reaching effect on a lot of different markets. So that's the situation that we're in at the moment. We've seen a big rally. Now, what we're talking about today is entry and exit points. So we need to have a look at where these markets are. And what I want to do is focus on something that we focused on yesterday. So yesterday we were looking at entry and exit points, but we were looking at them in the space of candlesticks. So we're looking at our candlestick trading and look for areas to enter the market. Well, if we look towards that entry that we had yesterday, okay, and our and what we had was we had our entry at a morning star formation that we spoke about yesterday. So that was here. That was this morning star formation here. 1, 2, 3, down candle, doji, up candle, then our move higher. Now, I showed you where we came out of the market at this sort of area, around these highs. That's where we came out the market. And we came out the market because we knew that they were very erratic market moves, okay? We knew that we were going to see big market moves and that the markets were very uncertain. So it was a case of coming in, taking some of our profit when we can. So if we take some profit when we know we can, like at this situation here, like at this point, at that point previously, then we know that we're making the right decision. So it's when to enter the market that was key. And on this situation, the way when we decided to enter the market was on our confirmation. And that's what we need to speak about today, confirmations. Because it's very easy to try and say that when a market has come down very aggressively, that what comes down must go up and what goes up must come down. So when we make our decision on trading, so if this market was falling here and the market was all the way down at this low point and we said, I'm going to buy it regardless, even to this point here. If we said, I'm going to buy this as soon as this doji candle formed, and we said, okay, I'm buying it because it's come down, I'm going to rally it up. 2 candles would have been right, and then we would have lost money further. So we need to make a decision on where we enter the market, where we get our confirmation from. So let's take, for argument's sake, this situation on this Dow Jones at the moment. We've got a double top scenario. Okay, now this is called a double top. So let's have a look. Let's look here. We've got one there. And we've got one there. A double top, which is an area where the market has come up to a certain level, failed, come up to a certain level and failed again. And it's done it twice at this same level, which is 21,446. 21,446. That's where we've been key and where we've entered that market. So the turnaround, move higher, turnaround. Okay, that's what we've seen. Now, the situation that we've got from here is we need to know when we enter the market. Now, from this point of view, we've seen the market come up, come back down. Yes, we've seen very big movements here, but we can't, as we just said about that oil price move, we can't use these candles as ones to dominate our market decisions on because they're too erratic. The market movements are too aggressive. For argument's sake, we could have very easily been sitting in a trend with our trend line from a 15-minute chart running here. Okay, forget those arrows for 1 second. Running here. And look what would have happened. Massive breakout, massive fall to the downside, and then a ramp up to the upside. Okay, big fall and a move higher. Okay, now that would have broken us out, and we could have, if we were quick, got in and made some money on these falls to the downside because the market did aggressively go, fell lower. But what we have to wait for is a confirmation. Okay, we have to wait for the market to confirm what it's doing. So, in this situation, we would have waited a hell of a long time. So we would have had to have waited for this candle, and as we spoke about yesterday, our candles and how they close, we'd have had to wait for this big down candle, this one here. We'd have to wait for that to close. Now that closed down at this level here. Let's have a look at that. Closed at that level there. So that would have been our entry level, 20,399. However, because that move, we still had that move, we still have that confirmation, what we would have then done is we would have said, okay, where's my target? Because it's very important to have a target in our trade. Well, we'd say, okay, probably down at around, we'd have to pinpoint some levels. So there's a couple of levels within here. There's a level that coincides here that coincides with previous levels as well. So let's look at that one just there. So a level where the market has come down bouts higher. Yes, it's broken, but it's also done the same thing here. We could have looked there. But does that give us a lot of trading room? No, it doesn't. It gives us what? 29 points. 29 points that gives us. So we probably would have looked a little bit lower. We would have looked at the lows. Because remember, we said, again, we stated this the other day. We said the key thing that we do is look for market highs and market lows. Well, this level here is yesterday's low. So yesterday's low, rally higher, breakout, and market comes down. We would have been taken out there. And from 20,939, that would have taken us down to 20,749, 190 points. 190 points that it would have given us on our move. Okay. And that is even after waiting all the way down here. We would have had to wait because this is our confirmation candle break. And then we go there. But the key thing is we would have had to have a stop. We would have had to have a stop that goes in place. And somewhere where we would have had to have said, well, okay, that's where I want, if our trade goes wrong, that's where I want to come back out of the market. But waiting for our confirmation, so waiting for this confirmed closure on here, now we would have felt some pain, wouldn't we? Because look how high this candle went up. This candle went up quite high. Which means if we'd have entered the market to sell here, we're feeling pain all the way up to there. We're losing money to there. So the market is another key example of us having to let the market breathe. We must let that market breathe. We must let it move in the way we want it to move. Okay. So if that does then breathe, then we have a good situation. So once we've got out of that, we then saw that the downside came in. We exited the market here. Now, is that a good thing or a bad thing that we exited the market there? Well, it's very easy to say that at the moment because we can see what happened to the chart, right? So we exit right here. That's our exit. We enter there, we exit there because that we don't want to take out any more risk. We don't want to run anything. We've taken a lot of points. Yes, we miss out on this, and yes, we miss out on this. Okay, so overall in this trade, what do we miss out on? We miss out on how many points from this high? We miss out on breakout down there, so that is 220 points. And then from this side down to here, we miss out on another 130 points. So in total, we miss out on 350 points worth of move. However, we do take this amount. And that's the more realistic way that we're going to trade. We're not going to be able to sell here, buy here, and take the full amount. We will be able to go in and take a smaller amount, though, take this amount within here and give us a bit more of an indication about how we trade and where we're going. Okay, so that's the sort of information that that's going to give us. But we now know that this market recovered and it's given us another situation. It's given us another double top area. So what we look to and we say, and what technical analysis gives us, technical analysis tells us the exit point. Someone's saying, please repeat the exit point on that red candle. The exit point was this low. So yesterday's low. There was nothing on this candle that gave us the indication. It was this candle here. Let me highlight that for you. It was this candle. It was this candle here. That's what highlighted us our exit point. Our entry was the confirmation. Our exit was yesterday's low. Again, it's very, very easy to pinpoint when we're looking at a chart that's already done something. But we have to remember that the market is not going to give us a perfect signal. The market moves down here. Yes, we miss out on a lot. We enter the market, we gain a lot, but we miss out on this as well. But we have to be happy that we took this. We have to be happy that that area that we saw between our entry level and our exit level, we have to be happy that we took that. And that worked out being particularly good for us. It was 190 points. 190 points is what it gave us. Okay, so just by looking at our entry and exit levels and saying, using very simple things like yesterday's low price, we can see how we can get into a trade. But now let's look at the upside here. We have a double top situation. Okay, we have one here. So again, let's highlight this one. We have one here. And we have one here. Double top situation. Now, what technical analysis gives us, and this is, remember, we're just looking at one chart here. There are a whole host of other charts that we can look at. But what this gives us, what technical analysis says is it says that levels that are important in the past will become important again in the future. So 1, 2, there are 2 at the top here. What it's saying is that the next time the market comes up here, so the next time the market looks to rally from this low point, from this area, we think that it will do this, and then it will do this. Because it will touch this level, and it will bounce off of that. So that's the indication that it's giving us. Okay, so that's how we will look at that. However, what could happen instead of that is this. If the market rallies up again, see we're getting massive irrational big market moves, the market could do this and go straight through that level. If it does, that's all well and good. There is still a buying opportunity within there. There's still a trading opportunity within there. We just look for a close of this level. And a close of this level, we want to see what? What is the key thing we want to see? Confirmation. And the confirmation is our candle closing. So this candle closing below this. So we saw our trend line, we broke below our trend line, and our confirmation was down here. Yes, it's a long way. And then we got our trend. If this comes up, we want to see it break. We want to see a confirmation. Now, if the confirmation is here and the market barely closes above it, that's when we get a little bit worried. We say, okay, let's give this a bit more room to breathe. Or maybe when I trade, let's have a slightly tighter stop. Let's have a slightly tighter stop. So our stop is maybe a little bit closer. So we're losing a little bit less money if it goes wrong. Okay, but that's the situation we have. That's where we're a little bit more, we have more opportunities. And if that confirms a break there, then we go, yes, that's bullish. We go, yes, that's bullish. I'm going to run this higher. So our exit and our entry levels are based on technical analysis, and they are based on the fact that we must wait for confirmation. We must wait for confirmation. So let's just show you this. Oh dear, come on. Let's just look at something else. Let's look at this this cable trade. So we've got this is sterling versus the US dollar. A big sell-off, a big move higher. And look at this level here. 120, my eyes, 24.89 is that? 24.84. 124.84 is our level on the upside. Happens to coincide with the 61.8% Fibonacci retracement level. Fibonacci's we will talk about next week. But this shows that there are two key support levels there. And you can see that the market is going to them, challenging them, but coming down. We have not seen a break, and we have not seen a confirmed break above this red line. If we do see a confirmed break above this line, then we look to maybe trade from a different area. But you can see if we take this to an hourly chart, zoom it out a little bit, you can see that this is the same red level. 1, 2, 3. Very range bound market. Okay? Very range bound market indeed. Now, if we take out here, we can see that there's a very strong uptrend there, and that potentially this is a false breakout of this. Because look what we've had. We've had a breakout and then a retest on the upside. So 1, 2, break, retest. Is this now coming lower? Is this now coming lower from there? That's the question we have to ask ourselves. But you can see that this is ranging. And if this does come lower, potentially it's coming down to this 50 level, which has been acting as a form of support on the downside. And we look to trade this in a range. But what we'd want to see is confirmation. Now, our confirmation of a sell signal up here is when the market doesn't break and doesn't confirm. Because we know here, if you look at this candle here, the market's come up, it's touched it, it's closed. That's our confirmation. Now the market's going to come lower. So there are a number of different opportunities that we can look out for if we just confirm our thinking. If we confirm those candles, we wait and be patient. And it's all about patience. It's being patient with the market. It's all about that situation. So as we go through our trading, we must wait for confirmation. I just want to show you one thing before we finish up here. As we said yesterday, if you open an account with us and trade, you will get, what we'd like to do is, if you open your trading account, when you put your money into your trading account, whether it be 250 minimum or anything higher than that, that money will go directly into your trading account. It will go directly into your trading account, and it will be sitting here in the equity tab of your trading account. Okay, it will be sitting there within that. However, what we also have on offer is free signals. Free signals if you open your account. You get free trading signals. Now, these give you free entry and exit points and tells you where to buy and tells you where to sell the market. If you look at this trade that we've got that is sitting here at the moment, we have a, what's this on? This is Sterling Swiss, one of the ones in here. It's a sell signal. You can see the trigger is 121,700. Okay, the trigger is 121,700. Which is 121,700. It's all the way up here. This is our entry level. So our entry level is up here, 121,700. Our target. So our target, and you see this is a sell price. This is a sell signal. So this sell signal then says to us, our target, our take profit target is down here. It tells us where to enter the market. It tells us where to stop it, to put our take profit. It tells us where to put our stop loss. So enter the market, take profit, stop loss. And this signal center is free when you open your account. So adding these signals gives you an indicator, it tells you where you can trade, where you should trade, and where you should enter the market. This is free on your account. When you open up an account and you deposit money into your trading account, you will get signals for free. However, you have to open an account. This is only available to new clients, and you must open your account and place your first deposit into your trading account to receive the signals. Apart from that, guys, I will leave it there for you today. Thank you very much for joining us. I hope to see you tomorrow on our next webinar. Our next webinar is tomorrow afternoon, 5 p.m. the same time, South Africa, 4 p.m. Nigeria. So thank you very much for joining. We hope to see you tomorrow, and it'd be a great pleasure for you to join us again tomorrow. Apart from that, guys, thank you very much for your time today. I hope this was a helpful webinar, and we will speak to you tomorrow.